Hi friends, in today's video I'm going to share with you which is that scheme in India, the deposit scheme in India which will give you exempt. 3 times exemptions, my friend. And the beauty about this scheme is that if you deposit an amount in this particular scheme, you get an exemption from a taxation perspective. Whatever interest you earn on the particular deposit on an annual basis, whatever interest you have earned, the interest component is also tax exempted. And finally, towards the maturity, if you get the entire capital appreciated amount along with the interest portion, the entire portion on withdrawal is tax free. Wow! Triple dhamaka. So which is that scheme, my friend? In this particular video, I'm going to share the name of the scheme and also few particulars about the scheme which you need to be aware of. That is with respect to loan facilities available, what are the implications with respect to if you are a non-resident Indian, and then also what are the withdrawals permissible on this particular deposit if you want to withdraw during the time of investing into this particular deposit or in this particular scheme. So let's understand all these aspects. So please subscribe, please share it to your friends so that they can get an understanding about what is this scheme and what are the particulars of this particular scheme. They get a thorough understanding, visibility, and if you still have questions after that, please drop a note in the comment section and I'll be replying to your comment as soon as possible. Okay, my friends, so let us see about this particular scheme. This scheme is called as the Public Provident Fund, so which is available to every citizen in India. Anybody. Now you may ask, can a child open an account just born? Well, yes, of course, the child can open an account. Of course, the child is not working, so the parents have to contribute on their behalf. And then, of course, if you're a teenager, you can contribute to the particular deposit scheme. If you're a senior citizen as well, you can contribute to the deposit scheme. That's the beauty about Public Provident Fund, open to anybody in India. Of course, the limits are you need to contribute minimum of 500 rupees to the Public Provident Fund if you want to avail the benefits of Public Provident Fund, and 500 rupees every month you can invest, or just 500 rupees for the year to continue that subscription in Public Provident Fund. So in the subsequent year, you need to continue your deposits of 500 rupees so that you can continue the scheme of deposits, of Public Provident Fund to be continued in your name. And maximum permissible is 1.5 lakhs. So under section 80C, you get a benefit of 1.5 lakhs tax exemption on your entire income, whatever you may be earning, of up to 1.5 lakhs. So if you're earning 10 lakhs, 1.5 lakhs of the 10 lakhs is tax exempted. So that's another aspect, the exemption on the deposit you made on the PPF account. So now let us see whether a resident Indian and a non-resident Indian, when you compare both resident and non-resident, what are the implications, what are the key things the non-resident needs to be aware of. So while you're a resident Indian, you can continue or open an account into PPF. We can continue your subscriptions in the PPF account up to 15 possible subscription, that means 15 to 16 years of subscription, after which it matures. But in between, if your status changes to non-resident Indian, then you can continue the subscription by investing into the particular deposit while you're abroad. So that's wonderful. Non-resident Indian also can avail the benefit of a Public Provident Fund. But nevertheless, if you're a non-resident Indian from day one, that means you are non-resident Indian and you had not opened a Public Provident Fund before, and you didn't have any subscription prior before getting the status of a NRI, then you cannot open a Public Provident Fund if your status initially itself is an NRI. So of course, when you return to India, when you achieve the status of a resident Indian, then you can open an account, and then when you move back later days of the year or subsequent year, you can continue subscribing to the PPF account for an NRI. So that's the beauty about Public Provident Fund. NRI also can continue subscriptions. So let's see about now the loan facility which is possible on the Public Provident Fund. So up to 25% of the loan you can avail on the Public Provident Fund, and the tenure of the loan is about 36 months, and it is very, very strict of 36 months. If you default on 36 months, then you have to avail much more interest payment. Otherwise, it is 1% more over the Public Provident Fund interest, whatever you get. If you default on closing the loan, then your interest portion goes up to from 1% to 6%. So you need to be aware of that when you avail loans on public provident fund. And then now coming to the withdrawals, after the 7th year of investing into public provident fund, you can withdraw almost about 50% of the amount for whatever purposes you might desire. So 50% of the amount on the contribution done until the 5th year end. So that is the total withdrawal permissible on a public provident fund. So that was entirely about it with respect to public provident fund. In case you think I have missed something, or in case you have a point to add, please drop in a comment in the YouTube comment section, or you can alert me if you have any queries or doubts which you might be thinking about, and I'll be glad to get back to you on your queries. See you until then. Bye.